analyzing the Magnificent Seven stocks from the best one to the worst one. What an amazing recovery that we had in those big seven. And congratulations to all of you that bought the dip on Microsoft and Meta and all these kind of companies. And you did not buy into the notion that just because CapEx is high, that means those amazing companies are no longer going to perform. I mean, it sounds crazy in hindsight, right? And I did a video on it explaining why I'm going all in big tech. And I explained why the whole CapEx argument is crazy. But the best part is CapEx is expected to peak in terms of the pace of growth this year in 2026, which means in 2027, 2028, those companies will still raise CapEx, but they're not going to raise it as much as they did because they front load those CapEx, which means free cash flow will turn positive, things will be better, and we're going to have the opposite tailwind going into 2027, 2028. So I believe the rally in those stocks is only getting started. I'm excited to talk about them as I bought Microsoft and Amazon and Meta during this sell-off, and even Robinhood's up like 28% since I bought it on Monday. But it's been a crazy recovery. So I'm gonna talk about them, and I really hope you enjoy it as always. Now the first one is Amazon. If you look at Amazon, the stock is finally going up. Amazon never goes up. It's up like 10% year to date. Many investors are saying the stock is up so much, it has to go down, it has to pull back. Well, maybe, but if you look at the 5-year chart, Amazon hasn't even doubled over the last 5 years. You have even Apple with no revenue growth growing 100%, Meta 124, Google 200, Nvidia 1,000, 1,100%. And then you have Amazon. It's not even up 50% over the last 5 years. So the stock is just starting to catch up to its fundamentals and the improvements in the company. And I think we could potentially see maybe 50, 100% within a year, 2 or 3 years. Not financial advice, but I think it's very, very possible as the stock is finally catching up to its fundamentals. Now you have many exciting things that came out of Amazon based on the latest letter from the CEO. And one of them is the chips business. And he gave us an update where Amazon is doing $20 billion in annualized revenue just in the chip business alone. And it's growing at 100%, which means Amazon's chip business is larger and it's growing faster than AMD's data center business. I mean, this is absolutely, absolutely crazy. And that's another business that started out of Amazon and then it could potentially be a major, major success. Another one, which I talked about it before, is mainly Leo, Amazon Leo, as they're going to acquire a company called Global Star for $9 billion. They intend to compete with Starlink and I believe ASTS Space Mobile in terms of satellites and a few other things. And as soon as they announced the acquisition, they also announced a partnership with Apple, where Apple will use Amazon Leo's network for satellites, features across iPhone and Apple Watch, and that will kind of support things like emergency contacts and other kind of contacts if you're not within the line. So again, the company is doing a lot of different things, and that's why I love Amazon. It's like a mega cap startup where they have all these kind of call options, and if one of them pays off, even half of what AWS has paid off or half of what the advertising business has paid off, the return would be absolutely, absolutely crazy. And I would much rather Amazon doing those things than paying me dividends or doing buybacks at those valuations. Another call option is the Anthropic stake of about 18%. Anthropic was recently valued at $1 trillion in the private markets. So that's a pretty decent stake for a company like Amazon in what I would call the leader in AI. And of course, you have Amazon Web Services. It has started to reaccelerate due to their partnership with Anthropic. The recent data center came online last quarter, and that's why growth accelerated. It's expected to reaccelerate further over the next 2 to 3 quarters. And if I'm looking at how much I'm paying for all of this, despite the recent rally, Amazon is still trading at about 15 times operating cash flow. It's not even back to what it used to trade at before at 17, 18 times. It used to trade as high as 30 times. Now you could buy it for 15 times price to operating cash flow for a company that's growing operating cash flow 20% and expected to continue growing operating cash flow 29, 28, and 23%. And again, I believe those companies are front-loading CapEx, and CapEx growth should come down, meaningfully over the next 2 to 3 years, which will really be beneficial for companies like Amazon, Meta, Microsoft, and many others. So I still believe Amazon is one of the most attractive ones of the big seven. Maybe the stock is getting a little bit extended on the charts, but in terms of the fundamentals, it couldn't be better. And it has a long way to go to catch to the other big seven or big six, you could say, related stocks. Now, the second one, which I talked about recently, I don't want to talk about it again, is Microsoft. So I'm going to keep it short. Microsoft has been getting sold off with IGV, which is mainly the software related ETF. You can see the correlation. The white line on the chart is Microsoft. The yellow line is IGV. The correlation right now is like 71%. It used to be up to 90, 95%. But you can see there's a very close correlation. Whenever IGV gets sold off, Microsoft gets sold off. Even though Microsoft is not a 100% software related business, they have, for example, the cloud business, which is the second largest in the world at a 21% market share, growing 39% in revenues. So how could you sell a stock with IGV and Adobe and all of them? It's crazy, right? But this is what the algorithms are doing. And I've been saying after a while, those stocks will start to diverge from IGV and they will trade based on their own fundamentals. And I think it's kind of already starting to happen. If you look at the latest announcement from Anthropic, they launched something called Claude Design, which directly competes with Figma and Adobe. So what happened was Figma went down 6%, and I believe Adobe also went down a little bit on the news, but Microsoft and other stocks did not go down. Now, that's a very different approach than what happened before. What used to happen is whenever Anthropic launches any new product, even though it has nothing to do with Microsoft, Microsoft would go down because AI fears and AI and AI. That hasn't happened this time around. Anthropic has launched something new, and Amazon did not go, and Microsoft did not go down, and a lot of other software stocks did not go down. So I believe they're starting to get traded based on their own fundamentals and not really based on software, AI, just sell all of them together. Now you have the OpenAI stake, which is a 27% stake. People say they don't like OpenAI, but if you look at the investments that Microsoft has made, they made a 17.6x on their OpenAI investment. It's expected to be worth about $215 billion. To me, this is not a bad bet at all. Now, the other argument is that most of the future revenues of the reserve obligations for Microsoft are tied to OpenAI, about 45% of them. And OpenAI, again, is unprofitable. Maybe they cannot meet those commitments. This is 100% valid. Although I believe OpenAI has a lot of fundings, Nvidia invested in it, Amazon invested in it, a lot of companies invested in it, and once they go public, they're gonna have much more money. So I believe Microsoft has at least 3 to 5 year runway with their OpenAI partnership for them to diversify away from OpenAI, and I think they're already doing it because they said the remaining balance of the obligations is growing 28% with Anthropic, and players, they are not tied to OpenAI. So I believe the company will be fine with or without OpenAI. And the valuation got so extreme that Microsoft was trading below whenever OpenAI even launched in like 2022. It was trading below that. Now it's back to 24 times earnings, which is still cheap, you could say, but the stock went as low as like 20 times. I mean, it be well below when it was when OpenAI launched. So I believe a lot of those things is likely priced in. And for me personally, OpenAI is more of a call option on Microsoft than the main investment thesis in Microsoft. I think it's mostly Microsoft Azure, and it's not all of it is tied to OpenAI. Okay. Now, if we look at the expectations of growth, it's expected to grow 22%, 13% earnings per share, 18%. In my valuation model, I put in 16% average for the next 5 years. I think Microsoft can pull it off. The current PE ratio is 24 times. I kept it at 24 times, and I put in the tiny dividend. All in all, I got about 106% on the upside, or about a 16% annual return on Microsoft, which is more than a double over the next 5 years. This is not a bad return at all. But if I want to use the average PE of about 27.5 for Microsoft to, you could say, use the best case scenario. If we put in 27 PE, I get about 131% on the upside, or almost a 19% annual return on Microsoft, despite the 17 or 18% rally that Microsoft had this month. I mean, I can't believe how oversold those stocks were, how cheap they were. They're still somewhat cheap. I believe Microsoft and Amazon are like tied in terms of which one is the cheapest. If I had to choose, I would choose Amazon because it's my largest position and it has what I would call a physical moat in logistics, and you can't just like vibe code a new kind of facility or whatever. So I like Amazon a little bit more, but I would rank Microsoft as second. The third one is Meta, which I also got the chance to buy during the sell-off, and I thank Mr. Market for that. It was a really amazing sell-off. It has recently recovered, but it still has ways to go. Now, Meta has launched a new model called Meta AI. This app, Meta AI, on the Play Store, which is mainly on Android, got 50 million downloads and more than 1 million views. It just launched not long ago and already got 50 million downloads and 1 million views. I mean, this is the scales that you have with Meta. Whenever you have access to 3.5 billion people every single day, you can launch any product and advertise it to almost half the global population for free. Very few companies can do that. And none of it is priced in a multiple, by the way, for a company like Meta. But we don't even know if the Meta AI thing is good or it's bad. But what the market cares about is that the company is spending on CapEx and it's actually seeing results. It's doing something with it. And based on this announcement, Meta recovered. And we're still about to find out how is it going to rank, if people are liking it, they don't like it. It's going to take some time to see what happens. But Meta is also finding a lot of efficiencies within AI. They recently announced that they're going to lay off 10% of the workforce due to AI-related efficiency. And, that's good for the company because they're spending a lot on CapEx, but they're actually seeing results. And if you look at how much they're spending on CapEx, they're spending about 60% of their operating cash flow on CapEx, 60%. They also spent that in 2021, 2022, when they had the metaverse and all kind of crazy projects. Now, if we look at what happened after they spent 60% of their operating cash flow on CapEx in 2022, the company has reaccelerated in revenue growth to about 23%, and it's been growing 20% almost every single quarter since September of 2023. So those investments have more than paid off, and they're doing it again, and they're actually going to pay off even more in the future. And by the way, I'm using fiscal.ai to come up with those charts. If you want to try it out, they give you 2 weeks of free access if you use my link in the description. But now Meta is a dominant player in ads. It has surpassed Google as the largest percentage of total ad spending, which is really, really amazing. And if you look at how much you're paying for all of this, you're paying about 22 and a half times earnings. I still believe 22 times earnings is cheap. I think Meta deserves a lower multiple because it's in the ads business. It's not really recurring revenue, even though they could get into more recurring revenue models over the long term. But for now, Meta deserves a lower multiple than Microsoft and other recurring revenue models because it's mostly in ads and it's a little bit cyclical, but still 22 and a half times. For a company that has this access and that's doing all these things with AI, I don't think the company is expensive at all, especially if you take into consideration that they're growing 20 to 22%. So you're pretty much paying 1 time the growth for Meta. So I also believe Meta is undervalued. Now, the second one is Google. Google stock has recovered in a major way. It's up 7.6% year to date. If you're buying Google, you get some amazing businesses like YouTube and the ads business and the Play Store and cloud and so many different things. And Gemini has been absolutely destroying OpenAI. You could see the market share gains here in the purple or red, you could say, and they've been gaining a lot of market share, and it's been really amazing from Gemini. Now, Google Cloud has also been gaining steam, not just in revenues, but also in operating profits. I remember back in 2023, the main argument is that the cloud makes no money, but since then, their profits have like 20x'd pretty much, which is really amazing for a company like Google. Now, Google also has a stake in SpaceX. It's expected to be worth $122 billion if SpaceX IPOs, which is about 5% of the company's total market cap. But my main argument with Google again is that I said that easy money has been made, which means in terms of a multiple expansion, it's getting a little bit extended. It's trading almost at 30 times earnings. The stock has never traded above 34 times forward earnings. It traded as low as 16 times with an average of 23 times, now trading at 30 times. So I believe Google has delivered some amazing returns over the last 1.5, 2 years. Most of it was not just earnings growth, it was a multiple expansion. Now, the multiple expansion story has mostly played out. Google could still go to 30, 35 times earnings. I would not be surprised at all. But would I bet on it if I'm looking to buy Google? I would personally not really bet on it. Now, if you look at the expectations of Google, they're expected to grow earnings per share about 15, 16% over the next, 2027, 2028. So if they grow 15, 16%, I get no multiple expansion, everything remains the same. I get about a 15% annual return on Google. But again, for me, Google relative to Microsoft, relative to Amazon, relative to Meta, I mean, it's not bad, but it's not really as attractive. I see way better opportunity in Amazon and no stocks. But I could potentially see, you could say, a 14, 15% annual return on Google. But I think Google is definitely not the best buy at today's price. Now you have another stock, which is Nvidia. Nvidia has had a massive, massive recovery. The stock is only trading at 24 times earnings. And I recently talked about Nvidia, so I'm going to try to keep it short. But my main argument against Nvidia is if you look at the forward PE, 24 times is really, really cheap, especially if you compare it to the earnings per share growth expectations of 75%, 34%, and even 21% potentially for 2029. The stock looks really, really cheap, right? But if you look at again, what's expected from CapEx, and I believe this picture is accurate, that a lot of those companies, even Meta said it themselves, they said we're front-loading CapEx. So they're investing a lot in CapEx right now because they're doing the AI race, but eventually the pace of this growth will start to decline. As the pace of the growth will start to decline, so will Nvidia, the earnings per share growth, and it's kind of built into the expectations, and it could decline even further. Now the question is, if the AI boom matures by 2030, 2031, and I think it will ultimately mature, what kind of multiples would those semiconductors be trading at? Now, they haven't been cyclical over the last 5, 7 years because we had, you could say, 2 back-to-back cycles. For Nvidia, it was the Bitcoin mining stuff, then they got into AI. Well, what's it going to be after? If there's nothing really too exciting after, the multiple contraction on a lot of those semiconductors as an exit multiple after 2030, it could be much lower than it is right now. Now, if you look at the average PE multiple of the semiconductor ETF between 2009 and 2018, it was 17.5. Now, in this period, we did not have anything that's too exciting. We didn't have AI. The internet thing has kind of played out. It was still playing out, but it was nothing like that's really, really exciting. Now, if that's how 2030 to 2040 looks like, or 2030 to 2035, then Nvidia could potentially trade at 17 times earnings. And I did the calculations, and it would trade at about, if you want to get it double, it would be around $165 per share. If Nvidia gets to 165, 155, then you can get it double in 5 years at 17.5 times earnings. Now, if I'm wrong and we have a new cycle after 2030, maybe space chips or some kind of chips, then Nvidia over here is looking like a steal. But for me personally, I like to value stock on the worst case scenario. And if I'm using the worst case scenario of the average PE outside of something that's exciting, I would get a fair value of Nvidia at under $165 per share. So I'm doing it very short on Nvidia, and that's my opinion on the stock. Then you have Apple. Apple, I'm never going to own Apple. I'm not interested in owning Apple. Apple has recovered. It's back to break even on the year. The stock trading at 31 times earnings. I think that's too expensive. If you look at the company's earnings per share growth, it's been really well over the last few years, 10%, 10.5, 14, expected to be 10, 11. But if you look at the revenue growth, it's much lower than the earnings per share growth. It's like 2% revenue growth, 6%. It's much lower than earnings per share growth. Now, the main reason why the company is growing earnings per share so rapidly for their size is to do the buyback program. So the company makes 135 billion in operating cash flow. They spend $12 billion on capex, very little on capex. They're left with almost $120 billion. Then they use 120 and they just buy back the stock. This is what they did last year. And that's what they did the year before, where they got about 98 billion in free cash flow and they spend $96 billion on buybacks. Now, there's nothing wrong with that. But companies that do that are companies that are more mature, are companies that are not finding a place to reinvest the capital, so they just give it to shareholders. There's nothing wrong with that. But I told you in the beginning of the video, I love that Amazon is investing in Amazon Leo, is investing in AWS, is investing in chips, is investing in all those areas, because those things drive growth. And I think growth in general is much more rewarding to shareholders than short-term buybacks and dividends. So for me, I'm not into the buybacks and the dividends. I like the company that reinvests in itself. So that's why I'm not buying Apple stock. And then you have Tesla, which I don't comment on because I admit that I don't really understand the company. It's mostly an Elon Musk kind of stock. Sometimes it's robotaxis, sometimes it's something else. And we don't know the kind of payoffs that could lead to Tesla stock. And again, there's a premium on Elon Musk. So if maybe something happens to Elon Musk, then what's going to happen to my investment? So I believe I'm not really a big fan of investing in those stocks that depend so much on one person. And if something happened to that person, then the business is done, or at least the valuation is done because it's built on that one person. So I try to skip talking about Tesla and I try to talk about stocks that I understand. So that was my opinion on the Big Seven. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.